Everyone, my name is Francis Sabourin from Richardson Wealth in Montreal with Hassan Ghaffari Aram that works closely with me on portfolio management. Welcome to our Q2 Review 2025. And the title for this quarter is Market Tune-Outs, the Noise. Obviously, there's been a very volatile quarter with all the noise in the market. So, obviously, Hassan, how will be better described this quarter?
Good morning and happy summer. If 3 months ago or 2.5 months ago, we were talking about again seeing all-time high in the market, that would be a very weird conversation. So April 2nd, Deliberation Day, was the day that Mr. Trump, the President of the United States, announced taxes on the allies and all parts of the world. The S&P 500 tumbled by 4%, and in a matter of a week, the market was down roughly 20% and touched the bear market. And everything was down, like oil was down, gold was down. The VIX, the parameter of the volatility or the risk uncertainty in the market, was at the 52 level on the April 8th. So the market was pushing about uncertainty, fear, risk off mode. And on April 9, the president came over and said, pause. When he said that, the market returned back again to the upside trend. The Nasdaq was up 12% in one day. S&P 500 was up 10%, and gold was up 3%. So the lesson that we learned from that, you can see all the events in this graph. Yeah, the big jump, the big slump in the orange line is the day that they announced the tariff, and it's all the way down to the April 8th. The lesson that we have from this quarter is this: the market and business care about stability. They hate uncertainty. So tariff rate is fact, but uncertainty about what's going to happen next is another factor, which fear the market. If the business leaders knows the story, they can work it out somehow. A very great example happened last night, Vietnam. So President Trump announced that he has struck a deal with Vietnam over the tariff at 20% tax on any Vietnamese goods entered to the United States. Okay, and the markets saw that as a positive news. When you put it in absolute number, before Trump, the tariff on the import of Vietnamese goods was at 9.5%. Then he imposed 40%, and now we're ended at 20%. At the end of the day, it's higher from 10%, but the market sees it as a positive factor. Why? Because now it's certain that's over. Now let's move on. So this is the important factor that we have to learn. Financial market is a little different from the real economy, because financial market is all about the future and about the certainty of the action. And that's the thing that we are looking for. That's how we invest based on the certainty. So yes, so as you see, Trump and the tariff was the main events of the market. But for us as Canadian, also we had the election on April 28th. We have Mr. Carney now at the Prime Minister, central bankers. So the market see it as a positive stand. The election result was not really eventful for the market. It was already priced in, and we are at the heart of the negotiation on the tariff. So the important factor is that the only takeaway that we are looking at is the new budget and new bill C5 from the Ottawa, which is very important on infrastructure defense spending. So which is going to define bond market, a little of the investment for some companies, some of the companies that we have in our portfolios, and also on Canadian dollar.
Following that, we have a serious major rebound on the market in performance of the equity market following this drawdown that we have early April.
Exactly. That was like the exact V-shaped rebound. So if you put it in the context of the only 3 months, that's fascinating. Like Tesla is up 18%, for example, although year to date it's down 20%, just to tell you how fast things can change. Microsoft, one of your holding your portfolios, up 30% in the quarter, and for the year to date it's up 20%. Nvidia was up 40% in the quarter, year to date it's up 18%. Amazon was up 15% in the quarter. So as you see, certainty come back to the market, and the market loves it. The chart here show you that the main leader for the quarter was the tech, because it was the most hammered sector in the market during the April 2nd to the April 9th. So they came back very beautifully. One interesting lagger of the quarter was energy. We talk about the energy. So you have a war in the Middle East, very intense war, but nothing happened, and the energy is a lagger. So we're going to talk about that. And the market is up 10% for S&P 500, and very strong rebound.
So also, the bond market and the U.S. dollar. So obviously this has been volatile too, and especially the U.S. dollar has been down more than up for the last quarter and year to date too.
Yeah, of course. I think we missed two slides. If we can, we're going to talk about the bond market for sure. Yes, that's it. So let's set the stage here. We have increased tariff. So all the market participants in the bond market and equity market were worried about, if you have higher tariff, you're going to have higher inflation. Higher inflation means higher rate. Higher rate means lower stock market and lower price for any kind of the assets. That was the main theme 3 months ago. However, based on the latest read of inflation, we haven't seen any upside or surprising upside tick in the inflation rates. So it makes you thinking that what's going on? Why the inflation is not going up? There's two reasons for that. First, so as you see, the authorities are playing with the tax tactics that they have, with the tariff tactics that they have, so on and off, pause and on. So that's one reason. The other reason is companies are hoarding on, importing in advance just to keep everything in hand, more and more in inventory to secure the consumer from higher prices at the moment. And like the latest inflation number that we had was 2.8%, only 2.8% versus 2.9% expected by the market. So we don't see that much of the inflation pressure from the tariff part. The other reason is, at the end of the day, the US economy is consumption service oriented economy. So it's very important about the economic growth and the wage growth and the job market. We're going to talk about that later. Look at the two graph, the blue bar graph that we have here. The top one is the US inflation actual versus the forces. So the green line is the target from the Federal Reserve. They want inflation at 2%. Where we stand at 2.8%. What's expectation is the orange line. As you see, the orange line is not crazy like 5%, but it's not 2%. It's more than that. So the question is, what is this gap? What is this difference come from? Is it because of only tariff? Is it because of the monetary policy, or it is because of the growth? If it is because of the growth, that's a good inflation. That's a good reason that the economy is good, we are in a good stand, and that's why we have higher demand. Unfortunately, for Canadian part, you see that the future inflation is pretty much at the 2% because we are not growing as fast as the US economy.
And between inflation and labor market, which matter the most?
So this is the question that just half an hour ago was the topic of everyone. Like we are at the July 3rd, we had the latest read on the job market like half an hour ago, and that's very important. So Federal Reserve, the central bank of the United States, has dual mandate, job market and also inflation. So inflation, we talk about that. It's not crazy up. It's not 2%, but it's manageable. And they're in a pause mode because they want to see the real effect of the tariff. So inflation is in that department. The next one is job market. So the latest read on the job market is that the US economy in the month of June created 147,000 jobs. It's a good number. The unemployment rate is at 4.1%. The expectation was 4.3%. So we had tariff, we had uncertainty, but the corporate America is still hiring. So this is good. The most important factor in this read is the increase in the wages. It was 0.2, 20 basis point month over month. Expectation was 30 basis point. Okay, so corporate America is hiring, but the wage pressure is not that high. Amazing for the stock market. You have inflation at the manageable level, and you have the job market very strong. So with this context, let's see what the market is thinking. The big chart that you see in your left is about the expectation, the real live expectation of the market. The blue line is 2-year inflation swap. What the market expect about the inflation of United States in the next 2 years. We are around 2.4, 2.5%. And the orange line is the important one. The orange line is expectation of how restrictive is monetary policy. There's some way to calculate that. They use the Fed rate expectation minus the inflation expectation. The subtract of these two is the real rate of Federal Reserve rate. So as you see, it's above 0. When it's above 0, it's restrictive. So that's level 1. Level 2 is the pace of the change. It's going down. Although we are in a restrictive mode, but we are in a less restrictive mode. So the next question going to be, when going to be the cuts from the Federal Reserve? Before this morning, we had some probability of cut in July and 100% in September, like 2 cuts. Right now, we are talking about 1 cut in September. So we'll see. It's fluid things. Last thing before we go, the lower chart is US PPI and ISM manufacturing price paid. So the orange line, again, is inflation. We talked so much about inflation, sorry, but it's very important. That's the main concern of everyone these days. The blue line is the price that the manufacturing people, the business owner, are paying for the raw material or inputs. As you see, we see a little jump in that at the end of the chart. That have to be panned out. We're going to see how it's going to translate, to convert to the final goods. That's a question that we'll have to see.
So this will lead us to the bond market and the US dollar.
Yes. 2 months ago, or let's say April 2nd, you will hear that, oh, US exceptionalism is over. The US as a reserve currency is at the risk. We're going to see people going away from United States asset. That was the theme of investment. There was so much talk about that. In the next 2 slides, we'll talk about that. So let's start from the right chart, the BZ chart that we see here. The blue line is the European Central Bank balance sheet. The higher it is, the more money they print. So the peak is during the COVID. They print money, they buy everything that they could, and it's they reduce the balance sheet. Again, they are buying money. You see, they're printing money. The blue line is going up again. However, if you see the US bond, the orange line, it's in a downward trend and it's not going up. Okay, so if you just see that, it means that the US dollar should get stronger and euro should get weaker. It was not the case in the last 3 months. The US got hammered in the last 3 months. The reason for that was, and the result of that was the US dollar. Look at the other graph. The red one is the US dollar. The US currency, the US dollar, is down 9% versus the others, and all the rest currencies are up. So what's happening? Why is that? So first, the market is expected that we're going to see cut from the Federal Reserve. That's one of the things. Second one was that when the US start talking about the tariff, so all the alliance of the United States stop a little buying of the treasuries. That was another one. And also when the US stock market goes down, especially Magnificent 7, the foreign owners of these stocks either sell or not buying. So these factors put pressure on USD. And on top of that is about the hedging strategy. So when the US get cheaper and cheaper, you have to hedge more and more if you are a foreigner. By hedging means that you have to sell US, you have to buy your own currency. So it's some kind of the ripple effect in the currency market. So that was the theme in the last 3 months. If we go to the next slide though, the main question is this. Should we now sell the US stocks to US asset and go to the Europe or international? What should we do? That from economic perspective, this question comes from the concept of twin deficit. So when a country has a current account deficit, import more versus the export, and also has fiscal deficit, the government prints more money for the fiscal, it's a risk. It's an alarming sign. We saw that 3 years ago in United Kingdom. You remember? It cost the prime minister of the United Kingdom that time. But in US, we have a special situation. They also have a very, very big fiscal account positivity. They have a premium in that scenario. So although they have a although they have an account deficit, current account deficit, they have exactly equivalent of foreign asset coming into the US market. And why is that? Is because the US market still is the most liquid, most deep market in the world. If I'm a Japanese, I want to go somewhere else, United States, the question is what can I buy? If I'm a pension fund of Japan, what can I buy? A liquid asset, there's no alternative. Look at the pie graphs. So the United States is 25% of the world economy. 25% of the world economy. However, its market is 64% of the global stock market and bond market. It shows you how deep is the US market. And also, 57% of the world currency is in USD. Your country, so United States country currency is the most liquid way of transferring wealth. So if you are a pension fund of any other country, you want to sell your asset, there's no other alternative. There's a gold as alternative sometimes, we'll talk about that, but at a long term, that's a game. Fundamentally for the stock market, if you are the investors, you have to answer this. What am I buying? You buy something which make money, which make profit. Profit in the stock market is EPS, earning per share. The graph that you have it here, it's come from the Alpine macro strategy group. Credit to them, it's an amazing graph. So the blue line is the next 12 months EPS forecast for the United States, the historical graph, and the rest of the world. As you see, there's a gap. That's why the US market was leading, will lead in future because of that. And where's the source of that EPS supremacy? Where's the source of these profit dominance? It's come from productivity, which is the factor of innovation, and labor market. Both of them are the first in the United States.
Good. And also, as we know, the US dollar and the US economy is the saving banks for all the world. So this is why we're still positive on the US dollars and on the US economy, even if there is some kind of a drawback for the last four or 5 months. So on the next topic is the Middle East tension, a temporary shift or in priorities or not?
So you have a look. Let's set the stage here. So for the last 40 years, there was always a fear that what's going to happen if there's a conflict real between Iran and Israel? It happened, and the oil price right now is at the price that was before the war. So the question is, is it not a catalyst anymore, the war in the Middle East? And as an investor, how should we think about that? So the first graph that you see here is the price of the WTIs. As you see in the let's say from 2023 to now, we are down 10%. So 10% down, the cheaper the oil. You see the jump at the end of the graph recently. That was the war. That was the attack of Israel to Iran, and then again came back after the ceasefire or truce or whatever you call it. So the question is, what happened really? When we talk about the oil market, let's put the stage what we're talking about. We're talking about at the moment $100 million barrel per day of consumption demand, and the production is about 102. OPEC is 40% of that production. So 100, 102, and 40%. And the expectation for the next 5 years is that we're going to reach to 114 as the production, and the demand is going to be around 106. So the supply and demand is in the favor of consumer, so cheaper oil price. That is the reason that all the OPEC members and non-OPEC members always try to produce more than their quota, more than their limit. The chart, the bar chart, the colorful chart that you see show you that how much more since 2023, OPEC members are producing above their quota. So that's one of the reasons that the price of the oil is always been more in downward versus the upward. So that's one of the reasons. So for economic perspective, as us as a consumer of the oil, especially the US people, the next question is, how important is oil for us? As you see in the last chart, last graph at the right, so the top line is the GDP growth of the world, how our economy is growing, and the red line is the production of the oil. So production of oil is not going up same as or in the same pace as the world economy. So it means that we are not that dependent anymore. So that's another good sign. So if you want to put more numbers in that, war is not good, never is good, but Iranian production is about 3.6 million barrels per day expectation, and they export 1.8 million of that each day. The worst case scenario for the oil market going to be 1.8 million is meaningless because you have around 5 million of spare capacity at the moment in the OPEC. So if the 1.8 million for any reason goes away, you have 5 million ready to pump in from Saudi Arabia, UAE, and Iraq, especially UAE. So what's going to be the worst case scenario? The worst case scenario is going to be in geopolitics if, for any reason, the Strait of Hormuz got closed. But that's like the suicide strategy because all that 1.8 million barrel goes through Strait of Hormuz to China. So unless there's some kind of end of era scenario for that kind of conflict, we don't see that's going to happen.
Good. And also on the last slide, I mean, we cannot escape without talking about gold. Obviously, this quarter has been pretty impressive for gold.
If you had bought gold for your beloved one, good for you. You save a good amount of money. Gold was the best performance in the last quarter, 30% up. And while the recent run leaves its one level to the little pullback, we still think there's a leg for the gold to go up based on fundamental. So these are all from Financial Times. Fantastically set all the important factors. So the big chart, the bar chart, tells you how much central banks are buying now or keeping gold as their reserve. We talk about the dollar. We talk about how central banks are maybe concerned about the value of the dollar. So they are increasing the reserve of the gold 2 times more faster in the last 6 months. So annually, they're buying 1,000 tons of gold at the moment in the past 3 years. It is 2.5 times more than the average rate. Just to put it in context, one of the big buyers is China at the moment. They have about China right now has 6.8% of its reserve in gold. The average for other countries is around 20 to 25%. Just imagine if China wants to go to 12%. What pressure going to be on the price of the upside pressure on the gold? And in the last 3 years, the gold has proven have less correlation to the risky asset than treasury bonds. So treasury bonds used to be a hedging strategy, risk diversifier. Gold is now play a better role. So you do have a gold exposure in your portfolio through the miners, and we still think that the gold is a good play for diversification.
So thank you, Hassan. And obviously Q2 has been positive in terms of performance. So year to date, as of June, as you will receive your statements, we're positive. So from the most conservative portfolio to the most dynamic portfolio. So whenever if any one of you wants the copy of this presentation, feel free to reach out to me, to Hassan, Jean-Marc, Michael, Chris, or Stefan for the team. So thank you for your time and see you next quarter.